welcome dear friends once again to this NPTEL MOOC module on international trade, theories and empirics. This is in fact the rerun course of the last module. Last year also it was floated, and I have been teaching international trade for over last 12 years in different organizations, including Indian Institute of Foreign Trade. So, I can guide you in most of the points of this course very clearly. Now, coming to this ninth week lecture on exchange rate determination. So far we discussed about functions of foreign exchange market. We have discussed about various concepts of foreign exchange market, especially the evolution of Indian foreign exchange market. Then we also discussed about types of foreign exchange market. Now, on the very last lecture of this week, it is relevant to discuss how it gets determined, which are the factors. Let us understand it. I am deliberately showing this chart to highlight some of the aspect which help us in understanding foreign exchange determination. So, theory of foreign exchange like monetary approach is very important in the discussion. Similarly, other theories of foreign exchange market, including law of one price, and that again determines the absolute and relative prices or relative foreign exchange market. And while we understand the foreign exchange and to determine the foreign exchange, there occurs through theory we can find out some dynamics of the foreign exchange market. And the dynamics will also guide us to clarify further on some concept called exchange rate overshoot. So, we will address one by one. Let us go for the clarity of determination through those approaches, through theories. Now, since floating exchange rates began in 1973, but in India I think we followed the pegged exchange rate till the third phase of our evolution. The international financial flows are now larger than trade flows, and this is the context we are referring to, the international market, where due to the floating exchange rate regime from 1973 there has been a shift of the focus to monetary theories of foreign exchange rates, since because it involves the role of money in the financial system of the banking system. So, monetary exchange rate theories view the exchange rate as a purely financial phenomenon and tend to explain exchange rate volatility and disequilibria in the short run. Now, understanding the exchange rate through two concepts first. One is called nominal exchange rate and another is called real exchange rate. Nominal exchange rate, we have already mentioned that what is the price of the domestic currency with respect to price of a foreign currency. When the price of domestic currency increases, that means the foreign exchange of that country depreciates. So, let us say that we have $1 equivalent to 0.6 rupees or 60 paisa or 0.6 of the rupees. No, sorry, $1 is equal to, it is 0.6 is very absurd. So, it is very clearly given, it is 60 rupees. Let us say $1 is equivalent to 60 rupees. We are talking about this number called nominal exchange rate. 60 is a nominal exchange rate against $1, and this is the rate at which we can purchase dollars. Now, we understand what is nominal exchange rate very clearly. Let us understand what we mean by real exchange rate all about and how it gets determined. So, in the same example 1:60 we cited between US and India, that means $1 is exchanged with 60 rupees in India. We to understand the real exchange rate, I think I have already given some basic information, but still for your knowledge that it has to be adjusted with price or the relative prices of both the countries. So, let us have for example, a McDonald burger in both the countries. Okay. So, in US McDonald burger can be purchased at $1. So, this means that for US resident in terms of US dollar, the cost of the burger is in Indian rupees it will be should be equal to 60. Okay. So, the cost of burger the US resident earning in US dollar, the cost of burger in India should be 60. Okay. Now, suppose the rate of inflation in India is 10%. So, cost of burger is no more 60 in India, which is equivalent to the exchange rate of 1:60. But since inflation occurs, inflationary tendencies or percentage changes are there, and on the average it is of 10%. So, that means what really happens, the price of burger increases 10%, 60 of 10%, it is of 66 rupees. Okay. So, now 60 plus 10%, that is 6. So, 66 rupees now. So, $1 is now traded with 66. So, now $1 cannot able to purchase a burger in India. So, due to this, the cost of burger in India would actually be equal to 66, which I already said. Therefore, although the US resident can able to purchase that McDonald burger at $1 equivalent to 60, because there was no inflation in US, so burger price still kept at $1. So, he cannot purchase burger of $1 in India because exchange rate is 60. So, he has to pay 66. So, extra money has to be paid. So, now there are many interpretations here. Now, due to inflationary factor, the real exchange rate actually increases. Okay. So, which actually depreciates the value of the currency. So, by the same token, the burger becomes more expensive for Indian residents even though the nominal exchange rate does not change, which I already said, nominal exchange rate is still 1:60, but 60 but US still burger price is $1. Okay. But India it is of 66 rupees 66. So, in India the person cannot able to buy burger, and this is because although $1 is still equal to 60, the Indian resident needs 66 to purchase the same burger. Now, thus this exchange rate, which is in the ratio of 1:66, earlier it has to be it was of 1:60, now it is 1:66. So, this gets impacted due to the changes in inflation and from the perspective of the purchase of products, due to the higher purchase or aggregate demand. So, it has an inflationary mode, inflationary tendency within a country. So, that is the reason why the real exchange rate gets changed. Nominal exchange rate may remain same, but it has got changed. Now, what we have understood here, when there are some change in the inflationary tendencies in another country, but there is one law which is universal, that is called law of one price. Okay. When price in one country is different than that of another country, then it is quite obvious, there will be arbitrager, then there will be brokers, they will purchase in one market and sell in another market, or purchase goods from one country to another country, because there are hardly any restriction to some of the goods. So, in those sectors where restriction is less, there will be huge mobility from one place to another place, and that will stabilize the country's currencies and their exchange rate. So, ultimately 1:60 is expected to be prevailed. Okay. So, that is the reason why it is called law of one price. Now, in other terms, what we have studied is called relative purchasing power parity based on the adjusting with the inflation. This is the purchasing power parity is divided into two parts. One is called absolute purchasing power parity, another is called relative purchasing power parity. The equilibrium exchange rate between two currencies equals the ratio of price levels in two nations. So, basically when you simply divide the price ratio of two countries, P of the domestic country and P star is the price of the foreign nation or foreign country, that is is defined as absolute purchasing power parity. Now, for example, if the price of bushels of wheat is $1 in United States and €1 in European market, then the exchange rate between the dollar and euro will be $1 divided by €1. Okay, so that will precisely as 1. So, when you simply divide the price ratio of the particular commodity, then if that ratio is defined as absolute purchasing power parity, and based on these are based on law of one price, which I have already said, it suggests that a given commodity should have the same price in both countries when expressed in terms of same currency. Okay. So, I mean given commodity would have the same price in both the countries when expressed with the same currency. So that the purchasing power of the two currencies is at parity. This has caused this is caused due to the role of commodity arbitrage. They purchase and sell to earn profit. And absolute purchasing power theory can be misleading because of some reasons. First is the fact that it appears to give exchange rate that equilibrates trade in goods and services while ignoring capital account. At exchange rate that equilibrates trade in goods and services, capital inflows would produce surplus in balance of payments, while capital outflows would lead to deficit. Okay. So, capital inflows would actually produce surplus in balance of payment, while capital outflows will actually define deficits, which we discuss in the balance of payment chapter. And this is misleading because this will not even give exchange rate that equilibrates trade in goods and services because of existence of non-traded goods. Such as international trade tends to equalize prices of traded goods and services, not non-traded goods. Non-traded goods are not going to be effective and not changing the prices overall. Now, what do you mean by relative purchasing power parity? It is basically not just the ratio of the relative prices, it is the change, also the change in the exchange rate over a period of time, and should be proportional to the relative change in the price levels of two nations over that period of time. So, a base year price is also essential. It is not just the price that is at present we are considering as a ratio, rather a base year price should be taken as a in the numerator for adjusting the changes. So, P1 is the price in the present period and P naught the price in the previous period of the domestic country divided by the relative prices with the present and the base year prices and their ratio times the R naught, and R naught is the exchange rate in period 1. Okay. So, and R1 is the exchange rate in period 1 and R naught is the exchange rate in period 0. So, basically the nominal exchange rate of this is basically the nominal exchange rate in the base year period. Okay. Nominal exchange rate in the nominal exchange rate in the base period, base year. So, out of the base year, how the relative prices are actually neutralizing the rate, and accordingly we define the relative exchange rate. Okay. So, basically sorry, so this is basically the exchange rate, real exchange rate, because we were trying to find out the real exchange rate every time. So, real exchange rate in new period is actually defined like this. All right. Now, coming to the purchasing power parity once again with some example, if the general price level does not change in the foreign nation from base period to the period 1, then the ratio would be 1, while the general price level in the home nation increases 50%. Suppose in the numerator the value increases by 50%. Okay. The relative PPP theory says that the exchange rate should be 50% higher, since it is increasing 50%. So, in the denominator there is no change in the relative prices and their ratio. The in terms of PPP theory, the real exchange rate or relative exchange rate will be increased by 50%. So, that means home currency should depreciate. Okay. So, when it is rising, home currency depreciates by 50% in period 1 as compared to the base period. These are some of the examples, the data which were taken by Salvatore's book, Dominic Salvatore on international trade. You can follow and the calculation is given. I have simply taken from that book for your reference. Okay. Of understanding the concept very clearly, that over a period of time how the actual and PPP exchange rate of the dollar vary from the period 1973 2005. Okay. So, in PPP sometimes it is higher, the actual is sometimes higher due to the inflational changes. Okay. There are some empirical evidences how PPP works better, PPP works less well, PPP works not so well, like for highly traded individual commodity. So, PPP works much better. Okay. For all goods together they are just on the average working, like for all goods including non traded goods, PPP does not work because it is not transmitting or passing through the prices to another boundary. Over long period of time, suppose the comparison is taken, then usually the average prices is going to be less fluctuating. So, PPP works much better. In the very short run it does not work. Okay. That is a very good empirical relevance from Professor Salvatore's book. And in case of purely monetary disturbances and inflationary periods, if it is very pure and changes are very unique, then that is very fine. In situation of major structural change, it is going to be very problematic. PPP does not work much, especially in periods of monetary stability. PPP works relatively less. Okay. Coming to the inflation differentials and exchange rate in this period, which country in that relationship as higher level, which are at negative relationship, you can just have a look. Then there are monetary approach to the balance of payments and exchange rates. As I already mentioned, we will discuss, we have separate modules for it. Monetary approach, basically the role of banking system is important, the federal bank or the reserve bank is important, and the monetary policies are very essential. The monetary approach to balance of payment views the balance of payment as a monetary phenomenon. Money plays a crucial role in the long run as both a disturbance as an adjustment. Okay. Now, under fixed exchange rate, how monetary policy works, we will discuss in detail, but in short that balance of payment surplus results from excess stock of money demanded that is not satisfied by a domestic monetary authority. Okay. So, balance of payment surplus results from the excess stock of money demanded. Okay. Under a fixed exchange rate regime, a balance of payment deficit results under this regime when excess stock of money supply that is not eliminated by monetary authorities. If it is not there, then there will be deficit. We will discuss in diagram in detail in our respective class. Just giving the overview of it, there will be surplus or deficit that is temporary and self correcting in the very long run, as pointed out by monetary approach in the exchange balance of payment and exchange rate phenomenon. Except for currency reserve nation, the nation has no control over its money supply in the long run under fixed exchange rate. How is it so? We will clarify with the help of diagram, and some basic clarification is that when it is a no currency reserve nation has actually no control for its long run changes, especially in the fixed exchange regime, because there won't be much changes in the exchange rate. Whereas, in case of flexible exchange rate, balance monetary policy is comparatively effective, like the balance of payment disequilibrium are immediately corrected by automatic change the exchange rate without international flow of money or reserves. Okay, so the quick correction is expected. Nation retains dominant control over its money supply and monetary policy. There are adjustment which occurs as a result of change in domestic prices accompanying the change in exchange rate. So, these are the relationship between money supplies, relative money supply and exchange rate. When money supply increases, the supply increases, the value of that particular currency, especially we are referring to money supply of US, that is dollar. So, the relative prices in the internal market of the dollar depreciates. So, the exchange rate also increases, that means the value of that currency, that is dollar, depreciates. Okay, so, there is a positive relationship between money supply and exchange rate. So, it is interesting, maybe we can take a note for quiz question also. Now, coming to the relationship between nominal and real exchange rate indices between dollar and the dues mark from that period, Professor Salvatore has already estimated and given this relationship. Usually, in these two relationships, real exchange rate stands higher because of inflationary factor. That means, in terms of real exchange rate, the value of that currency actually is lesser. Okay. In nominal terms, it is lesser than that of real exchange rate. Last one to be discussed is called portfolio balance approach. We will discuss in its respective class in detail. The portfolio balance approach suggests that the exchange rate is determined in the process of equilibrating or balancing the stock or total demand and supply of financial assets. So, this is related not to the money of the banking system, rather due to the assets of the country because of portfolio balance approach. So, it suggests that the financial assets is the equilibrating factor. Okay. The exchange rate is determined in the process of equilibrating the balance of stock due to the financial assets. So, of which money is only one asset, but there are so many other assets in each country. This is regarded as a more realistic and satisfactory version of monetary approach, okay? Because monetary approach only consider money as the unit of the changes, but it also includes other stocks as a portfolio. If investor demand more of foreign asset, okay, either because of higher relative foreign interest rate or increased wealth, demand of foreign currency. When we demand more of their assets, so demand of foreign currency will increase for sure, so depreciating our domestic currency. And the reverse is true, like if the investor sell foreign assets, then we are we are not demanding much of their currency. So, our domestic currency and the exchange rate will appreciate. Okay. Then the exchange rate is determined in the process of reaching equilibrium in each financial market. There is another concept called exchange rate overshooting. Exchange rate overshooting due to the changes and due to the market determined rate of foreign exchange, there are many fluctuations observed in the very short period, like stock adjustment in the financial assets are usually much larger and quicker to occur than adjustment in trade flows. Okay. So, stock adjustment are more quicker, so that has impacted the exchange rate overshooting. Most of the bottom up adjustment in exchange rate comes from financial market in short run. Okay. Thus, exchange rate must overshoot or bypass its long run equilibrium level for equilibrium to be quickly re-established in financial markets. So, there will be possibility of overshooting due to the adjustment in the assets and financial flows. So, there are some empirical tests on these two, that is monetary and portfolio balance approach. We will also refer those things in our later part of the lectures, but still for further clarification, I just wanted to mention that there are models of exchange rate have not been very successful at predicting future exchange rate. Okay. The reasons is that predicting future exchange rate is very difficult. Reason is that exchange rates are highly influenced by new information, okay, which are not speculated, which are not estimated correctly, Similarly, expectation in exchange rate market tends to be self fulfilling. That means, at least in the short run, expectations are very difficult to gauge. So, these speculative bubbles may eventually occur and generate movements in the foreign market, contrary to what is expected in the theory. So, these are all the aspects of foreign exchange determination. I think in terms of diagram also, demand and supply, I think we have shown it earlier. Just demand and supply, if there will be change or shift in the demand and supply patterns, there will be further changes to it. Okay. And since market determined rate is prevailing, so demand and supply due to all of those reasons are responsible for the change in the exchange rate. So, that is all for today. We will look forward all those further details in these aspects in our later part of the lecture. Thank you.